Good afternoon. You're watching Businessworld Live here on One News. I'm Jess Delos Santos. Let's take a look at how the local bourse closed today, Friday. Okay, the index jumped anew today, extending its rally for a second day. Local shares inching closer to 6,900 after it made a 0.9% climb to 6,897. This pushes the PSEi to a third weekly gain, this time surging 1.6% over a 5-day period. Earlier in the show, Aristine Mercado of China Bank Securities says this is maybe because investors are no longer paying attention to the rising cases. Case in point, we reached new peaks in infection at 22,000, and yet the bourse remains buoyant around 6,700 to 6,800. And with offshore investors becoming net buyers for a number of sessions already, then this rally might actually have legs. According to Mercado, he expects the index to test the 7,000 level in the next 2 weeks. Although there would still be strong selling pressure at 6,900, he says once we get to see a consolidation between 7,000 to 7,100, then we might see prices pushing higher beyond 7,200. He still sees a possible end to the year at 7,300 for the index that's contingent on the improvement in vaccination rates in the country. Now, Mercado says it might actually be a good time as well to raise funds in the equity space due to good liquidity, a recovery story, and low interest rate movement. And that's precisely what happened to DNL Industries' maiden bond sale. Orders totaled 13.8 billion pesos. That's 5 times higher or bigger than the original offer size of 3 billion pesos. With that oversubscription option of 2 billion pesos might be on the table, increasing issue size to 5 billion pesos. So that's going to be 3 billion pesos worth of Series A bonds maturing in 3 years with a coupon rate of 2.79% annually. Series B bonds as well worth 2 billion pesos that will mature in 5 years at a rate of 3.6% per annum. Money raised will be used to fund the company's expansion plans in Batangas, including a plant which is expected to operate commercially by May 2022, at least partially. Now, shares for DNL today, however, not getting a lot of push from investors here. The stock got sold off today, down by 0.25% to 8 pesos and 28 centavos a piece. Here are other headlines we're keeping our eyes on. U.S. vaccine maker Moderna has gotten the green light for the use of its COVID-19 shots for adolescents aged 12 to 17 in the Philippines. But the Food and Drug Administration clarifies that Moderna is still under emergency use status, meaning the health department will still determine priority recipients within the age group. The Philippine Genome Center has also confirmed that the more transmissible Delta variant is now the dominant kind in the Philippines. This was previously declared by the World Health Organization. Community transmission of Delta is seen mainly in Metro Manila and Calabarzon. Now, the tourism department says severe hits from the pandemic has slowed down the utilization of the budget allotted for them this year. Tourism Secretary Bernadette Romulo Puyat explains that last year, both international and domestic arrivals plunged. Employment in the sector also took a hit, with at least 1 million jobs affected. Puyat says they have so far utilized 39% of the 2.8 billion peso budget for the year, owing it to on and off lockdowns affecting tourism business operations. The department is seeking a bigger budget for 2022 at 3.7 billion pesos as it focuses on strengthening domestic tourism. Puyat says plans include government shouldering half of the cost of RT-PCR tests conducted in local tourism operations. Now, with several businesses taking a hit this pandemic, loans have also taken a dip, prompting concerns for the banking sector. Tourism groups, exporters, and other business associations say there is more hesitancy to get loans, with companies unsure when operations will stabilize. Lower bank lending and rising bad loans have also prompted worries of the banking sector collapsing. But the central bank remains confident that such a doomsday scenario won't happen anytime soon. The Bankers Association of the Philippines also assured the public that the sector remains resilient despite challenges. With a spike in non-performing loans showing no signs of letting up, can banks really weather an economy that's still crawling towards recovery? To discuss that and more, we have on the show ING Bank Senior Economist Nicky Mapa. Good afternoon, Nicky.
Hi, good afternoon. Thanks for having me on the show.
Thank you for joining us. Okay, so with the rate things are going, just how vulnerable are local banks now, and for how long can lenders absorb loan losses?
Yeah, I agree with the central bank in saying that, for now, things are looking still quite stable at the moment, and we can weather the storm. But I think the real threat or the real risk we have going forward is that we continue to stay in this sort of low growth scenario. And the longer we stay with business sentiment down, that's also going to keep a lid on your bank lending. And of course, that's how banks are going to have to earn their money in a landscape of low interest rates.
Now, given that, are we still expecting NPLs to rise further in the coming months? What are the projections here? Do you have any models?
Yeah, I think the BSP is looking at something about 5%, a little
Mhm.
over 5% by the end of the year. If we continue in recession or recession-like growth into next year, then we might see this close in on 6%. The longer this drags on, the more pressure on bank health we'll see in the coming quarter. So, yeah, really the name of the game is to get out of this recession that we're in, and that's going to ensure that the banks will be stable and resilient.
Is there any dangerous level here that we are looking at? I mean, that we are trying to monitor? Is 5% by the end of the year still going to be a healthy level for the banking sector?
I think at that level, it still looks quite doable. Banks have started to aggressively provision for these losses anyway. But I think the fear here is that if those NPLs continue to rise and FIST hasn't really kicked in just yet, and that's really going to impair bank lending in the future. Even when things are a little bit better, banks will still be saddled with all this bad debt, and they won't be able to dispense their function as a financial intermediator for the entire economy. So, yeah, just like anything, the longer we stay in this very susceptible position, it's always going to be increasing the risk that the entire economy will be facing in the coming months.
Okay, now on a macro level, you are also sounding the alarm for a possible credit rating downgrade. Why is that?
Yeah, well, one of the main metrics that some of the credit ratings agencies, at least the major ones, one of the metrics they look at is overall debt to GDP levels. This basically measures a country's income versus the debt that they carry. And then now the Philippines is above the so-called 60% magic threshold. Anytime you go over that, that sort of raises alarm bells for these credit ratings agencies. And we've moved to that level as early as March of this year. And it doesn't look like we're going to be exiting from or going below that threshold for this year and even next year. I think the DOF is flagging us above 60% debt to GDP level next year of above 60%. So the longer we stay at this level, we're more susceptible to a credit rating downgrade. And if things don't change, I think we might be lined up for one as early as next year.
Okay, what steps then do you think should the government at least take to somehow temper or at least to somehow prevent a further increasing in terms of GDP to debt to GDP ratio here from 60%, at least maintain it at such level and not to further increase it?
Well, just the thing with the debt to GDP ratio is that it's a ratio. So you have the numerator and the denominator. So two ways you can go about this. You can limit the impact on your debt levels, which I think is the current strategy of the government to sort of hold back on spending. But at the flip side, you can also try to bring down this ratio by growing faster. So the GDP starts to pick up. This will at least offset or move that ratio below 60%. One very good way of doing that would be to pump prime the economy. It is a bit counterintuitive to spend more, but I think spending to get the economic wheels turning is one very good way to ensure that you might increase your chances of avoiding that ratio from continuing to rise. It might actually help it come down if GDP is restored.
Okay, now this time also, how do you think is a widening deficit going to put pressure on the central bank?
Well, I mean, the monetary authorities have said that they continue to push or hope that the fiscal side will continue to deliver its share of stimulus. It will be, I guess, on top of their minds as they see, a possible ratings downgrade in the near term or in the medium term, as that might put pressure on them to hike interest rates. But for now, it looks like BSP is going to be on hold, I think, for at least a year. Governor Jokno signaling he'll likely stay dovish because the economy is in well need of stimulus at this point. More stimulus, not less.
Okay. Now, there's also a push, of course, to do granular lockdowns instead of the regional lockdowns like what we've had since the pandemic started. How might this help for a more solid rebound for the economy?
Yeah, well, it's no secret that the sort of the recipe to get the economy back on track is to get the public sector health crisis sort of contained. If granular lockdowns are able to do that, then very well, yes, this will have an impact on your growth scenario. But I think it all boils down to that execution of these plans and strategies, so that we can limit the spread of the virus. At the same time, ensure that our healthcare sector is not overburdened. And if we do that, then maybe we can start letting people out. One thing we have to note is that throughout these past few months, we've tried different strategies, oftentimes trying to do a bit of both. I really believe that as long as you get the health sector crisis dealt with first, then you can start to look at the economic measures to boost the economy.
Wait, Nikki, the last time we talked, second quarter figures just came out. This time around, of course, we're already in fourth quarter. I mean, we're on our way to the fourth quarter. But how are things looking like for the third quarter, given the rate things are going?
Yeah, I mean, we continue to be in some form of sort of heightened restrictions, even if, there has been some moves to relax some of those mobility curbs. But, PMI numbers just came out the other day. Our numbers are back in contraction. And it just shows you how detrimental these lockdowns can be for the manufacturing sector, and you can be sure that the services sector is feeling the heat just as well. A lot of the services sector are intensive, are heavy on personal interaction, and because of the social distancing and all of these measures, these mobility curbs, it's going to be very difficult to expect the services sector to bounce back in the third quarter in a big way. So we're not actually very optimistic. We think the full year GDP falls below the 4% lower threshold of the government and settles at 3.8% for the year.
Okay, so still not hitting government targets there. But for the third quarter alone, what are your projections so far?
It should skid around about lower than 4%, looking right at about 3.7, 3.8%. This follows a trajectory of a slight pickup in quarter-on-quarter growth. However, if you remember last year when we reopened the economy, we could see the 8% quarter-on-quarter growth in terms of GDP. It's not likely going to be the case this year, as the economy is really hobbled by all of these extended lockdowns. It's starting to become chronic, and I think that's what's going to hamper our growth momentum in the near term.
Okay, and lastly now, when do you see us again hitting pre-pandemic levels? And at the same time, just how long can we expect this economic scarring to last?
Yeah, I mean, the longer we stay in this sort of recessionary mode, the scars will build up. And previously, we had flagged the return to pre-pandemic levels of GDP as far late as fourth quarter 2022. But with the way things are going, we might see the return to pre-pandemic levels of GDP as late as mid 2023. So a long slog before we get back to that. But hopefully, we can contain the virus and get our economy back on its feet.
Okay, that's going to be a long wait. Thank you for your time this afternoon. Again, ING Bank Senior Economist Nicky Mapa.
Thank you. Stay safe.
Stay safe. And those are the biggest stories of this trading day, September 3, 2021. Catch Businessworld live again Monday next week at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Delos Santos. We are One News. Mask on, wash hands, and stay safe. Philippines, have a great weekend.